Now, American Century may very well come out first in the ANT race, the active non-transparency race. And we know you filed for a bunch of funds, value, growth, as well as sustainable. What's your thinking on why these strategies are suited for non-transparent disclosure funds?
So let's start off with the value and growth strategies. The purpose behind them is you're bringing forth what I would call the best ideas of a portfolio manager that are they could be more concentrated. And so the point is that it doesn't matter now when you're 5 million, 10 million, but as you get bigger and you make changes, one, you start worrying about free riding. So do people start mimicking the portfolio if it's as successful as we hope? And the second part is, do people start seeing what you're trading? And so using the example of maybe we own Apple in the portfolio and it's the top holdings and it goes from 3.5% to let's say 2.5% one day because we can't trade out all of it, and the next day it goes to 1.5%. Can people front run those trades by seeing that every day? And the goal here is to protect the alpha, the potential alpha generation that these portfolios could offer,
especially as they get bigger. Now, the Presidian model in particular uses a kind of blind trust approach where only the representative knows the exact holdings,
yes.
While other ANT structures use, for instance, a proxy basket. What's your thinking on the merits of the blind trust route versus the proxy basket? In both cases, how certain can you be that the spreads will be tight?
So one, let's start off with what you call the blind trust. So remember, there is some information out there. It's not just the AP representatives or the authorized participant representatives that know the holdings. There is something called the VIIV, which is published every second. So unlike a mutual fund, you'll be able to see the value of this portfolio every second. And because it's US-based securities, you'll be able to see within a good reason of what it's actually worth. So you can determine when you want to buy and sell. So it's not totally non-transparent. There is some visibility. But what I think you get from that is it allows a portfolio manager that's comfortable sharing anything to put something into that portfolio that they feel confident no one, as I said, can front run or free ride, and really look forward to that comfort zone of that product and put forth their best ideas forward. And that's kind of what we're doing. We want to offer our best structure and be vehicle agnostic. There are clients who prefer mutual funds. There are some that prefer ETFs and, quite frankly, SMAs.
Now, speaking of mutual funds, I want to get your thoughts on pricing as well, because you already have an American Century Sustainable Mutual Fund, and you have an ETF version of that. The mutual fund institutional class charges about 75 basis points. When you price it, when you price the ETF, that is, are you thinking about appealing to the mutual fund customer, or are you thinking about getting the ETF customers to basically pay up?
So no, the way I would word it is when you think about how you're going to price, and I can't tell you what the pricing is yet, but how you're going to price, what you're looking for is you want to price something that's fair for the value you're offering. You don't want to underprice yourself, and yet you definitely don't want to overprice yourself. So what I would tell you is you definitely want to price something that's fair and in the range for that value. And if you look at some of the other structures that have become public, everything's going to be roughly within the same ballpark, I think. So obviously I know what we're charging, I know what some of the others are charging. I don't think you're going to see anything at 90, and I also don't think you're going to see anything at 10. I think there's going to be a range where they sort of all fall between, but hopefully we'll be in there when we share what we're doing.
Okay, so it'll be clustered. Speaking of pricing, American Century has a line of ETFs under the Avantis name. They're active, cheap, and transparent. They're run by a former Dimensional guy as well. Why not just stick with this route instead of going the active non-transparent route?
So if you think of what they're doing, right, they're using an academically time-tested approach that's been proven to work in the past, and they're continually improving. And then you look at the number of holdings that they own. I mean, you're talking AVUS probably has 2,000 to 2,500 holdings. That's very different than having something that's 40. Now, they're very different than what American Century has traditionally done. If you look at American Century, it is a fundamentally based shop that, you know, does a bottom-up approach and does stock picking from that. And so when you look at what they do, so going transparent on the Avantis lineup, those gentlemen that we hired, makes sense for what they're doing. If you look at what the rest of American Century does, we want to bring forth all of our products, not just one set or one fragment. You want to bring forth all of it.
Got it. Now, you used to work at Vanguard many years ago. The firm announced it'll launch a private equity fund for institutional investors. Very quickly, I just wanted to get your thoughts on what the strategy might be here.
I mean, I'm not sure what they're thinking about. I mean, for someone as big as Vanguard, or anyone that big, you have the opportunity to test the market and see what works. And I think if you have the ability to test, incubate, no matter who you are, what size you are, if it makes sense for your firm, it can make sense for the clients.